I want to tell you the signs of a market crash, how to prepare for it, and what I'm personally doing. So if you're new to the stock market, if you haven't invested yet, you're thinking about getting started in investing, this might be a good video for you to watch to tell you whether or not you should start or not. I'm not going to tell you personally what to do because I'm not a financial advisor, blah, 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 but I'll tell you what I'm doing and I'll tell you all the signs and I'll explain it as easy and quickly as possible. So I got a napkin here. I wrote down some notes that I thought about. Let's get right into the signs. Let's just get right into the video. So the first sign is greed. That's the first note. Seeing greed. So the classic Warren Buffett, one of the best investors in the entire world. Be greedy when others are fearful, and be fearful when others are greedy. Right now, I'm being fearful because I feel like everyone is greedy. And why do I feel like everyone's greedy? The market is at all-time highs. We're seeing meme stocks like GameStop, AMC, people talking about it. I'm literally eating dinner at a restaurant the other day, and I hear people across the table saying, yo, did you get into AMC? Oh, man, yeah, I got into GameStop. Man, it's going to go to the moon. Stonks only go up. And you just hear all these meme talk. That starts to scare me. When the janitor starts talking about stocks, or Charlie Munger once said, like the shoe shiner, what a tongue twister. The shoe shiner starts talking about stocks, you need to get out. That's a scary time. So we're seeing the classic greedy signs. A lot of people are being greedy. That's number one. So in your personal life, if you start noticing, hey, stocks are getting popular around me, I keep hearing about them, it's kind of scary. Number two, printing money. The Federal Reserve, all right, is printing a ton of money. And if you don't understand this, I'll try to explain this as easy as possible. Our money is infinite. Money, the way money works is it's not like there's a limited supply, like, okay, we have $1 billion, $1 trillion, and we all have to share it. No, there's infinite money. We just print more and more money, and we get into debt to ourselves, to the Federal Reserve. So the Federal Reserve in 2020 and 2021 has printed more money than ever before. Record numbers. Later I'll go on the computer, I'll show you some charts, I'll show you pictures to look at of exactly how much money we've been printing. It's ridiculous and it's scary. Why is it scary? Because of one word, inflation. Inflation is when the cost of normal things in your regular life, anything, starts to get more and more expensive and your dollar's value starts to go down. Historically, inflation has been around 2 to 3%. So it's normal. If you go back to the 1990s, the early 2000s, things were way cheaper than they are today. It's normal, it's common sense because we slowly print more and more money. Now, in 2020, 2021, we've printed record amounts. Why is this scary? Because if we see higher inflation numbers, what is that gonna do? That's gonna make everything more expensive, your dollar worth less, so what am I gonna do with that money instead? I might as well invest it. So that's one of the big reasons too why I think the market's still at all-time highs right now, because people are thinking, all right, all this money's being printed, I might as well put it in an asset because I know my dollar is going to depreciate, which is smart, and I'll get into it why, but that's just another warning sign. Number three, interest rates. Here's what interest rates are. So the Federal Reserve controls these interest rates, and there's a 34-minute video or so on YouTube. It's called How the Economic Machine Works by Ray Dalio. Please watch that video. But I know most of you are not going to go and watch that video, but if you can, watch that video. It's really good. He explains it the best, but I'll try to do my best summation of the interest rates here. Think of interest rates as a lever. The higher they are, the less people spend money and the more cool our economy is. The lower they are, the more people spend money and borrow, and the higher our stock market goes. Why? Because when interest rates are low, it's cheaper to borrow money. If interest rates are at 1%, and right now they're at all-time lows, by the way, they can't really go lower than where they are now. I would rather borrow money since I'm paying low interest and go build a business, invest in stocks, do whatever I want because interest rates are low and it's cheap to borrow money. It's called cheap money. But when interest rates are high, I don't want to borrow money. I don't want to pay off high interest. I'd rather put my money in a savings account where that savings account is going to pay me higher interest. If you noticed, let me get a drink of water. If you noticed back in even 2018, 2019, those online savings accounts like ally.com, all those online savings, they had like 2-3% interest rates. They were paying pretty good money to leave your money in the bank account. And at that time, the stock market wasn't doing so hot. But when the interest rates dropped, because right now Ally pays like 0.5, which is way less than what they were paying just a few years ago, now everyone's like, why am I gonna keep my money rotting with no interest rate in the bank? I'm gonna put it in the stock market. Let the stock market do more work for me. So that's interest rates. That's another warning sign. When you see interest rates going down, you know the Federal Reserve is desperate to keep that market propped up. That's one of their weapons. Printing money, interest rates, all right? Keep note of that. You'll understand why this is important later. The fourth is PE ratios. A PE ratio is it's the price to earnings ratio. If you look at any stock, you'll see on the chart, there's like a 52-week high, 52-week low. There's a PE ratio. That number tells you how expensive the stock is. So if it's a PE ratio of 20, that means that stock is trading at 20 times the price of what it's earning. You're paying 20 times earnings to own that stock. Generally, the S&P 500 has been around 15, 16. The S&P 500, by the way, just in case I have to say it, is the top 500 companies in the US. It's basically how we measure how the stock market is doing. It's one of the metrics. There's the Dow 30, NASDAQ, there's other things. Anyway, the S&P 500 right now is sitting close to 40. That's more than double the average of 15. That stock market is very expensive right now. That scares me. And then you start to look at things like Elon Musk tweeting about his own company, Tesla, which I'm a shareholder in and I love the company, but I have to say this. He's saying his own company is overvalued in his opinion. And it is. I think the PE ratio is like in the 1500s, like a ridiculously high PE ratio. I'll pull it up on the screen later. I don't have any laptop or anything with me. That's ridiculous. When the CEO of his own company says it's overvalued and people still keep buying it and driving the price up. That's a huge warning sign. High PE ratios. The dot-com era, we saw PE ratios around the same level as they are today. In 2008, they were worse. They were much higher. But still, PE ratios are very high. It's another thing to look out for. And fifth is a summation basically of everything, bailouts. We're being bailed out by the government. Stimulus checks, unemployment extensions, unemployment boosts, PPP loans, all this free money being handed out. Do you wonder why it's being handed out? It's because if you saw what happened in March, which I know you did, that huge drop, if the government did not step in with all these bailouts, the market would have crashed way worse. The market would have kept going down. They had to stop the bleeding. So these bailouts, they're good because it's a short-term band-aid. But what about the long run? What's going to happen? Are we going to see higher taxes? Are we going to see high inflation? What's going on right now? And here's two basic things you need to know about inflation. Inflation, the supply of money, yes, the more supply of money means more inflation. But why haven't we seen hyperinflation right now if we printed so much money? I mean, things are more expensive, but not that much more. It's because of the velocity of money, how much money is moving around. So when people get out, when this whole lockdown is completely over and people are spending money, traveling, money is moving all over around again, inflation can creep up and will probably go up higher and higher. That scares the Federal Reserve. What are they going to do to react to that? How are they going to combat that inflation? Because we don't want to be like Venezuela where the dollar's like, their money's worth nothing at this point. They're going to have to raise interest rates. Why? To calm the market down. To make people say, oh shoot, it's expensive to borrow money and spend right now. I'm going to slow down. So raising interest rates to low down inflation. But the Fed has told everybody that we don't plan to raise interest rates for the next 2-3 years. And that's why the market's at all-time highs. But lately, we've been seeing a little bit of volatility. Why? Because not everyone believes the Fed because they know if things open up and inflation comes up, the Fed's going to have no choice but to raise interest rates. It's not going to be like, oh, we'll still wait 2-3 years. No, you're going to have to raise it now or suffer the consequences of inflation. All right, let's talk about how to prepare for this now because I'm giving you all these warning signs and this video is not meant to scare you, by the way, or like keep you, oh my God, the market's going to crash tomorrow because we don't know what's going to happen. I just want to prepare you for this now and tell you how to be prepared knowing everything that you know now. The first thing is to avoid margin or debt in general. Personal finance, avoid credit card debt, all those loans. Get yourself together. Don't have any of that. That's just terrible. Never have credit card debt. It's terrible. But as far as trading stocks, investing, if you can, avoid margin, which most of you should. You shouldn't really use margin. I think most people do not need to use margin. It's too risky. Let me explain why. And also, I heard someone like 2 days ago, I was at the gym with his AirPods working out. He's like, yeah, I'm all in GME right now. I'm using margin. Man, I hope that thing goes up on Monday. That's scary. That scares me. Let me tell you why it scares me. If you're using margin and your stock goes down, let's say, I don't know, 20, 30%. If you're using your own money, you can just hold and wait and ride it out to the top. But if you're using margin, you can get what's called a margin call, meaning the broker will say, hey, this stock's dropping too much. If it drops this much, we risk our own money that we lent you. So you know what? We're going to sell that stock at a loss, give you back pretty much nothing, let you lose your money and take all our money back because we're not dumb. We're not going to risk our money. And that happens all the time. So maybe the market's meant to drop 10%, but because everyone's using margin and they get margin calls, it goes down 20%, 25%. So you want to be careful with margin. Don't be in a situation where you're forced to sell Rather, I would take this time now while market's still at all-time highs, relatively still high, to get out of margin and just stay with cash or whatever you can afford to have in the market. What you can afford to lose. That's the golden rule. People need to go back to the basics and understand this. Have your personal finances order, have your emergency fund set, and then that's when you go and play with stocks. And you don't need margin. You don't need to borrow money and put yourself in a weak situation. The second thing is, don't time it. People are trying to time the market. I know this whole video is if a stock market crash is going to happen or not, and it makes you think, all right, should I just have everything in cash and wait? And if you own stocks, should I sell them all while they're high right now and then buy back in when it's low? The answer is just hold whatever you have and keep averaging in. Don't try to time it, because yes, the market is going to crash. It will come. But the market from here can go up another 20, 30, 40, 50%. You can miss out on all those gains, and then it drops. What are you going to do then? There's so many people that back in 2008, 2009, when the market went to all-time lows, they waited and they saw in 2010, oh man, the market, no, it's going to crash again. It's not going to recover. 2011, oh, it's going to crash. 2012, I bet in this video I can find a warning sign for every year that the market's going to crash. 2015, 2016, 2017, every year someone says the market's going to crash. Every year they say that, but the market's been going up. So you don't want to miss out on it. It's extremely difficult to be able to time, this is the bottom and this is the top. Because if you knew how to do that, you'd easily be a billionaire. But it's very, very, very difficult. Studies have shown the best thing to do is buy stocks when you can personally afford them and just hold it. Investing is long term. When I say the word investing, I'm talking 10 plus years. If you have a shorter time frame than 10 years, you're not investing. You're gambling. You're doing something totally different. This video is not for you. If you want to gamble, you got to go to like learn how to trade or something and gamble and go to the casino. That's totally different. Investing, you're buying a company like McDonald's. You're like, all right, McDonald's is going to be up in the next 10, 20 years. I think it's going to do well. Then buy it. Who cares? Maybe you buy it a little expensive now. Who cares? 10, 20 years from now, you'll still be at a profit. And if it crashes while you hold it and you have extra money, you average down. You just buy more for a cheaper price. That is the best strategy. Don't time the market. And number 3, which leads me perfectly to this point, is have cash on deck. You need to always have a cash reserve. I know cash is trash. I know cash loses value to inflation all the time, but in the short run, having cash will help you sleep at night. It'll be your savior. Not only for your own personal life, emergency fund, your car breaks down, you need to buy a new car, you have your cash, but also as like an opportunity fund. Like I could pull out and, oh wow, this stock just crashed 50% when it shouldn't have. I have all this extra cash. Buy the dip and hold. That's why you have cash. A lot of people back in March, I saw comments all over YouTube on all the stock market crash videos. I wish I had money to buy the dip. Oh my God, I wish I had money right now to buy all these stocks so cheap. People didn't have money. They used all their personal money. They used all the margin they could. They were leveraged out and they just watched the market dip more and they couldn't even capitalize. So don't be that person. Have a strategy. Have your emergency fund. Be ready to capitalize. And the last point to prepare is a basic fundamental finance point. Diversify across not only different stocks, but different industries. So industrials, consumer, healthcare, different types of companies. And not only that, if you can, different asset classes like real estate, peer-to-peer lending, which I have tons of videos on. And you could do bonds and gold, and treasuries. But personally, I don't touch bonds and gold. I know it's good to like hedge and have some of that so it's more stable. And in the short term, yes, your portfolio won't dip as hard. But in the long run, the returns of gold and bond are not as great as stocks. I would rather diversify into crypto, which I do have some crypto, very small percentage of my portfolio, but I do have some crypto. I'm not a big fan of crypto, to be honest, because I don't see it as a productive asset. I'd rather own a actual company like Tesla that produces vehicles that makes money than I just don't understand cryptocurrency or Bitcoin enough. It's just whatever the next guy's paying. I mean, yeah, there's blockchain. I'm sure a lot of people are going to be offended by what I just said, but I'm just not big on crypto. All right, that's it for my notes that I wrote down. Here's what I'm doing. What I'm doing is I'm holding down whatever companies I own right now, whatever stocks I have, my investments, I'm holding. Basically, with me, I don't have a sell button. My sell button is broken. If I sell, it's because something fundamentally changed with the company. There's something, this company I know is going to get disrupted or something big is happening, or there's an opportunity that's so great and I don't have enough cash and I need to sell these other stocks to take advantage of it. So, for example, in my opinion, Tesla dipped when it went to in the 500s range. I sold out of like Amazon and Google to buy more Tesla, but that's my own personal opinion. That was my own decision, right? Don't just copy me and think that. A lot of people will look at me like, you really sold Amazon, Google to buy more Tesla. Tesla has a PE in the thousands, ridiculous. Yes, I did, because I believe in Tesla long term. It's just what I'm doing with my money. That's why it's called personal finance and investing. Make your own decisions. Anyway, that's my strategy. Buy and hold. Have your personal finance, your emergency fund in place. And when the crash does come, and it will, you just buy more. Until then, I'm dollar cost averaging in every single week. Just throw a little bit of money in the market here and there, whatever I can afford, and you should do the same. Always sleep well at night. Don't have a bunch of margin and risk everything and check the market every 24/7. I barely check the stock market. I barely have to look at it. I don't care. I really don't. Like, if the market dips 50%, fine. I open my phone. Oh, it's down 50%. All right, let me transfer some cash over. All right, buy the dip. Cool. Chilling, stress-free. You got to be like me. Anyway, like the video if you enjoyed it, you know, all the good stuff. Subscribe, notification bell. I'm going to throw 2 videos up here. And comment down below if you want me to make a different type of video, whatever you're interested in. If you want to know more about, I don't know, interest rates or inflation, whatever you want me to talk about, comment it down below. Until then, I'll see you in the next one. Peace.